Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so I am live here with Brett Ashley Barth. Just really excited to spend some time with her today and sit down and talk about all things asset management. Brett Ashley Barth just has an amazing background. Prior to co-founding Capital Creek, she was her previous firm was a $9 billion RIA in Houston. She's got extensive experience in the client advisory and family office space. Graduated from Columbia University with a BA in American Studies. Capital Creek Partners, just a high-level overview, and she's going to go a little deeper, is a boutique multifamily office which serves a small number of prominent families, and they've grown to an organized investment partner to serve the needs of family offices, foundations, endowments, and private investment companies. They're located in Austin, Houston, San Antonio, and Denver. So, Brett, welcome to the show. Thank you for making time. Hopefully I did a good job with a high-level overview, but excited to just kind of have you go a little deeper and maybe just start with your academic background, kind of what you studied in college, what you thought you would do, and then, hopefully it's okay for me to pop in with some questions or comments as well as we kind of go through this.
Yeah, of course. Thanks for having me. Happy to be here. So I'm a Houston native, one of the rare few, it seems like these days. Grew up here, went to Columbia for undergrad, as you mentioned, and I was an American Studies major, which, these days is not as well known. It's an interdisciplinary major with a focus on, political science, history, English, and then you choose a concentration and ultimately write a thesis. So my concentration was Southern history and culture. And I ultimately wrote my thesis on the development of the South, or the myth of the antebellum South, and the development economically and socially post-Reconstruction. So kind of that's a whole probably topic of its own. But what I loved about American Studies, especially in, areas where people are less familiar with a liberal arts education, I think for me, what was really important about it is it teaches you to think in so many different ways, with, a broad focus on different topics and changing every semester. You really get a critical thinking view of different things. And so, and then with the deep dive of the thesis, kind of the process around the research, the due diligence, and the creation there has been, exceptionally applicable as time has gone on. I, went into college partially thinking, New York investment banking. I graduated in 2009, which was not the best time to find a job in the investment banking world, particularly in New York. So I came home to Houston. I worked briefly for a startup, which I think more than anything was a character building experience. And I learned a lot about how to not run a company and not do things, and ultimately laid the foundation for, how to launch a business later on. And then as, we work with founders in our different investments, things to look out for. I joined my prior firm with my now business partner shortly thereafter and have worked with him my entire career. I started with him on the advisory side of the business, and then we branched off to launch the alternatives platform there, which at its peak was about $1.8 billion. It started as a mix of hedge funds, credit funds, kind of long, short equity, and then we started building out a private equity platform. In this transition, the firm was a portfolio company of a large, well-known private equity firm, and they began to transition out their position. They sold to 4 families, and at that point, the firm had grown exponentially in the time I was there. When I started there, it was about $3.5 billion, and at our departure, it was about $9 billion. So as you can imagine, the number of clients and people changed, and the business. And so Robert Gant, my partner, and I had always talked about, the family office world and building a multifamily office and kind of taking what we've seen in the growth of the wealth management space, applying that to, our philosophies on what we thought families larger families were looking for. So, two of our main focuses in launching the firms were alignment and access. So the alignment perspective, in so many firms and places you see, people are just selling products. They don't, it's the flavor of the month, whatever they get in, whatever their platform is pushing. And as we've seen for families, a lot of these have multiple hidden layers of fees. The performance is mediocre, and it's just something to fill a place in their portfolio. For us, we have, as partners of the firm, have invested about $110 million of our own capital. We all pay fees, and we invest in every product alongside our clients. So everything we do is completely aligned with the families we manage money for. The other was access. We have built out an institutional focused platform. We hired our CIO, Mark Schoberg, from the Stanford Endowment in 2022, and he has helped us build an incredible platform. That was one of the things, like I mentioned with the alignment piece, is that for families, a lot of families were just seeing large, kind of two ends of the spectrum. Your large buyout, kind of the non-sexy, lower performing funds, as I mentioned, with minimal fees. And then you have the other end of the spectrum, which are kind of the friend country club deals that people were seeing. Someone's raising money, you invest in it, not a lot of diligence to be done in different things. And so what we wanted to do is bring what was happening, the investment process that's happening in endowments, to families. And so that's where the nexus of our vision was. We launched with 3 families at the end of 2018, and we are working with 23 families as of now. And then we've expanded outside of Texas with our Denver office opening last year, and some families along the way for investments.
And what was the role that you had at the startup?
I was a project manager. So it was a web development company that had 2 underlying kind of online tech platforms. And so really got, it was really interesting to see, especially at that point, kind of nascent, this was one of them was a dating website, and this was pre-dating apps.
Yeah.
And so kind of seeing all these different parts to it and how it worked and managing the team. But definitely an experience.
That's amazing. Yeah, I have a crossover. When I was, starting out my career, I did project management for some time too. And it was really tough because you pretty much had to be the glue, right? Kind of working with the designers, working with the developers, working with the client. And I got blamed for everything, right? No matter what I did, if there was anything that went wrong, it's like, oh, the project manager dropped the ball. So I think with that responsibility comes kind of the other challenging parts of it too. So yeah, but it's a great role. I think, would you say that you definitely use project management in your current day-to-days, right? Managing stakeholders?
Absolutely. I mean, I think, for kind of, even though it didn't obviously work out, I think it was a great first role out of college, right? I was working for a company I was the third employee. And so I was on the ground level of kind of seeing how everything ran and what everyone did. And as you mentioned, from the project management perspective, we are still, as a multifamily office, it's a client service role. Our families are our business. I mean, we're astute investors, but client service and what we provide for the families is the true core of the business. And so same sort of deal. It was managing, the relationships of all the underlying moving parts, the designers and the project, and also managing, the client side of their experience, their expectations, the deadlines and deliveries. So it really gave me kind of a look into the fast pace of, managing these relationships, expectations, how people, what happens when you have someone that's very upset and calling you and you're 23 years old and you have no idea what to say. And so it was a great foundational start to the career. And then from there, I joined my now business partner, Robert Gant, at our prior firm. I started with him on the advisory side of the business. We then transitioned to build our alternatives platform, which at its peak was about 1.8 billion. It started with a multitude of kind of hedge funds, a liquid credit fund, long short equity, and then we started building out private equity investments there. We also kind of built a nascent family office services group, which ultimately didn't take foot there. when I joined that firm, they were at about $3.5 billion, and a well-known private equity firm had made an minority investment in them as a portfolio company. So I was there kind of from day one, and as they came through and managed, and then the growth of the firm. And, as you mentioned, when we departed, it was about $9.9 billion. And so seeing how that shifted over time, and how, client experience shifted, investments in products and different things. And that's just the general, from that period of time, as the wealth management landscape began to shift for families, particularly larger families. And so when that firm exited, my partner and I had always discussed kind of the family office side of the world, working with a smaller group of families, and really kind of trying a different model than what was the general wealth management standpoint. And so two of the things when we launched the firm that were important to us were alignment and access. Alignment, is really important to us. We invest in all of our products. We pay full fees. The partners and employees have invested about approximately $110 million of our own capital at this point in the fund, which I think is really important. We had started to see it in a lot of different shops that, there's always a product, right? And people are selling a product and recommending it. And you'd ask, like, are you investing this? And most of the times the answer was no, right?
Sure.
Like, they have a platform that they're selling, and there are different models, and different fits. But for us, it was really important that alignment was there. That, we participate in everything that we do alongside our families. And then, the other, major point was access. So the other thing we had started to see was through, our relationships. My partner had been on the board of TRS and Utinco, and other relationships we had in the endowment world, was the difference between the investment opportunities the endowments and foundation world were getting to see and invest in versus kind of what you were seeing on the wealth management side of things, and the disparity there, especially, from performance. And so for us, we wanted to focus on access, bringing an institutional endowment style investment platform to families. So we have built that over time, focus on lower middle market investments. Our CIO joined us from the Stanford Endowment, Mark Schoberg, in 2022, and has helped really build that out. But, I think one of the things the families have really loved is the different types of managers that we're seeing, the opportunity set, something different than kind of your run-of-the-mill large buyout private equity firms.
Sure. Yeah, you're the second person that I've heard that has started to do kind of the endowment style model. One of my good friends, Roger Vincent, he used to run Cornell's private equity program, and now he spun out to do Summation Capital, and they're doing the same type of strategy. So I think it'd be really helpful to have the audience understand, the benefits of an endowment. I think what's great is, it sounds like it's a little different than an evergreen structure, right? Because you can kind of continue to reinvest. And I think there's some benefits also to the LPs. So maybe you can unpack a little bit around kind of how the endowment model works, and maybe some of the interests from LPs, like why they like endowment models as well. If that's,
yeah, absolutely.
That's
all right. So, as I mentioned, with, our experience in the industry it's just kind of a flavor of the month, right? Like, something is interesting, people get on board, they're excited, something's coming around. And, some of these tended to be just kind of rifle shots, and there really wasn't a look for people necessarily at the full allocation of the portfolio. So for the families, we are their OCIO family office. We report on their entire holdings, we look at their investments, and we allocate amongst the entire portfolio. From the endowment model, obviously they're generally a perpetual capital situation. And so you're investing, and as we do, in all asset classes along the way. I think one of the questions that we, tend to get asked sometimes is, what's your favorite investment right now, or what's really exciting? And while there are things that are exciting and kind of different tactical opportunities that come up over time, I think for us, it's less of, an asset class selection and more of a manager selection. So, what we're looking for are managers that we can build long-term relationships with, and really having capital in the hands of good allocators. So, as the cycles shift and the market changes, they have the ability to make those investments, make those shifts. The firms we're investing in are largely lower middle market, so they are smaller and more tactical than some of the larger funds. As I mentioned, we invest in all asset classes annually. We have a vehicle that we use. It's an annual vintage, so it isn't an evergreen structure. It's something that came up out of need from our families because we began, originally kind of with a smaller number of families investing, as is individually. And then just as that number grew and the number of investments grew for a lot of different logistical reasons, we created our vehicle that we utilize. So this allows us to work with, a bunch of different managers. We do both, funds and then co-investment and direct as well, kind of within the breakdown of those 5 asset classes. Our main asset classes being private equity, venture, real estate, natural resources, and credit. So, the other thing with managers is, we have a long, slow due diligence process. I think we've seen a lot of times where it's easy to get, you get a pitch and it's easy to get excited. And, for us, it's really taking the time to get to know the manager, their strategy, who they are, their character. Because to us too, character is just as important as performance. I think, when you're looking to have someone be the steward of your capital, they both are important. You can have some people that have exceptional performance and maybe not as great character, and that is usually a no from us. We want to be partners with people for the long term and people that share the same values that we have as well. So when we do commit to a manager, our expectation is that it's, we're not investing in just one fund, it's the next, 10 funds or however. So, and that's something I think, the endowment world does, as well as just these long continued relationships. We also have the ability kind of at our size to work with more emerging managers. With the size of our mandates, we're able to work with newer funds, newer managers, and then get on board earlier on, which can be beneficial for our families as well. Helping seed managers and different things like that. So I think we get a lot of great exposure, a lot of great depth, and then we have, a full-fledged investment team that runs our due diligence process, and they, really dive in, produce incredible due diligence work. And so, it's been great for the families who are kind of used to a little bit more of like a kind of higher level, superficial process.
Sure. That's helpful. So, I took note of you mentioning that you serve as an OCIO. So it might be helpful for the audience, especially the allocators that are in the audience, to kind of learn the suite of services that are optimal for, most of the families, right? So kind of starting from, supporting people with operational due diligence, there's wealth management services. So can you just kind of unpack the ecosystem and kind of unpack the services that I think are ideal for, just supporting these families and kind of their needs. And I know every family is different, but what are some of the things that you maybe have on a checklist as you're kind of working with the family to figure out how you can help them?
Yeah, absolutely. So one of the things I'll mention that kind of helps shape this is a majority of our families are actually first generation entrepreneurs. So they've created their wealth, within some recent time frame, some a little bit further than others. So there may not necessarily be, a fully built out portfolio.
Sure.
Sometimes there is, sometimes there isn't. But I think, number one for the families is the organization, right? So we come through, we consolidate all of their reporting, we bring in, the data from all of their managers, all of their holdings, and really give them a clear picture of what they have and where it is. And it's pretty surprising how many people do not have that option. Mm-hmm. Maybe they have an Excel spreadsheet here or some statements here, but for some of the families to finally kind of see it all in one place is really helpful. And then to know that somebody's watching it. I think, peace of mind is another thing we bring to the families. We, work with them on managing their exterior manager relationships and things like that. From the OCIO, process, then once we have a handle on the entire portfolio through this aggregation and reporting process, we then go through and do an allocation analysis and a cash flow analysis. So looking at where their portfolio exists currently, how, what it will take to get to kind of our model and what we think will be the best model for them going forward based on their particular characteristics. Then we do a cash flow analysis as well. And a lot of things kind of play into that. But really that helps us, especially around the private markets allocation, planning for capital calls, distributions, things of that nature, so that we can account for this appropriately. One of the things that we look at, especially from an allocation and cash flow perspective, is we kind of divide everything into two buckets, living and legacy. So, for the families, living is obviously, what you need today, what you need to keep going, if anything, kind of what you need to pull from the portfolio. And then legacy is, what do you want to leave behind? Is it creating, generational wealth for your children? Is it philanthropic? Is it both? Is it, and so really helping families think through about what that looks like for them going forward, because that ultimately also affects our allocation perspective. And that can, obviously the allocation, we have a holistic, and then for each entity, it can go, split based on those. We also, one of the, it's funny, one of the things that is a service we offer for the families is aggregation of K1s. So as we all know, K1s are a necessary evil. Every investment creates one, and every year they keep coming. And so we actually work with our family's third-party providers to track those, keep it updated every year and help them collect all of those. It's something.
Yeah, because there's so many logins, right? I mean, some people might be working with another fund admin, and they've got to go to that fund admin and get a portal. And then to your point too, even just when it comes to looking at your holistic financial well-being, some of these entrepreneurs might have had a job from 10 years ago where they still have like a 401k, and maybe they forgot about it, right? I don't know if you ever deal with that, but like just kind of having someone just go through a checklist and just get access to all the accounts, because there's just accounts that probably you and I just probably forgot about from like 4 or 5 years ago, personally. So having someone just kind of go back and hunt all those down and have some type of, and then do you guys have some type of software that shows like a whole, or like just maybe a report or something that kind of shows that larger picture?
Yes. So we have a reporting platform that we utilize, and it has, both creates reports that we'll, send out to clients, and then an active online portal where they can log in, excuse me, and see in real time where things are, held, how they're allocated, things like that. And then we create, like I said, more in-depth reports for our clients. So just that, the peace of mind and the knowledge of knowing I can log in and I can see where everything is, and some families go more granular and include things like art and, property and cars and different things. And that part is really kind of up to the clients on how much they have. But from an investment portfolio perspective, it's really impactful to see everything in one place. And to know that somebody's watching it over for you, to have those conversations, to keep track of things, as markets are moving and making investments. And like you said, just managing the portal logins, and the documents. So.
And then I got a question for you, and, just answer, in the way that you're allowed to, but, many of these different entrepreneurs come from different backgrounds. Maybe their business that they generated wealth in could be like a cybersecurity business, right? So do they tend to lean towards just investments that's more closer to their expertise, or have some of them kind of gotten to real assets or gotten outside of their expertise? So, that's kind of one question I have, but like just any other high level trends or patterns that you've seen, again, whatever you're allowed to share, but just, I thought it'd be kind of interesting, to analyze, if there's patterns based on kind of, how people invest.
Yeah, of course. So, people generally obviously tend to drift towards the things they know, right? Like they, in their different sectors, they understand as they see, deals come through, you'll look at some portfolios and they're very heavy allocated in one industry, which, from that perspective too, is also helpful to us as we go through the investment process and we're doing, due diligence on platform deals. Clients can serve as subject matter experts, right? Like go to them and say, okay, what are your thoughts on this operator, company, et cetera, and getting their perspective. Our goal, on the investment side, advising them is to broaden their portfolio. to have them allocated across all asset classes. So there is a diversification in the portfolio. And that's really what we also try to achieve with our vehicle, that has, it's kind of 5 asset classes. So those are customizable. The allocation across those is customizable for the families, and to account for what may be, overweighted in their portfolio already. So if it's, an energy family, we can kind of zero out the energy sleeve and overweight the others to give them exposure, or vice versa. So yes, they love the deals of the industry they're in, and they know it better than anybody. And, we help them with that. And if they have something they want to diligence, but our goal is to help them create kind of a truly allocated broad portfolio that isn't overconcentrated.
Yeah, no, that's helpful. And then, you talked about the services that you provide and the ability to, essentially over time compound capital. What are some of the considerations when you think about asset protection, right? So probably some life insurance plans, or, obviously just the policies that are going to help them maybe protect their assets. I guess, do you guys support them with some of those services? And if so, like what are some of the things that are top of mind for these families as they think about that? And, obviously when there's eventually going to be the second generations and third generations, and talking about like just their estate planning, any things that would be helpful to maybe bring up or talk about when it comes to that aspect?
Yeah. So we work with, a majority of the families come in with, pre-existing relationships of an estate attorney, tax accountant, et cetera. So we work hand in hand with their existing third-party providers.
Yeah.
With that estate plan. It does rank, one family looks very different from another, and some come in, very structured, and some are ready to get structured. So we work with them and kind of helping them map out, kind of goes back to the living and legacy. What does that legacy look like? What does it look like long term? And then working with their providers to kind of structure that appropriately. So if, we do have trusted providers we work with, if the family doesn't have, say, an estate attorney or something like that. But that's a partnership with them, with us, third-party provider in the family, to really help them craft what makes the most sense for them going forward. And that's such a broad range based on what they do. So looking at different, and also too, like location, states, tax planning, estate planning. I will say one of the things that I think is pretty consistent amongst the families and has been important as, first-gen entrepreneurs is generational education. So, working with their children to become good stewards of their own capital, to understand what they have and how to manage it, and, getting involved, whether it's, starting someone with a small investment portfolio that they kind of take charge of, and we kind of help them through that. Just like going through the nuts and bolts of investing, basic investing, and really making sure that, they have the education that they have to continue to grow this generationally. The other thing we help families with is philanthropic, planning. Family foundations, starting family foundations, helping them think through, the causes that are important to them, the impact they want to create with their wealth, and also, getting their, children, second gen, involved in that as well, getting them engaged and understanding the importance of giving back.
Yeah, no, that's helpful. And I totally agree. I mean, there's your alma mater, Columbia, they have these family office, family generational, programs that they have. And, I can imagine a lot of families, send their kids to those, accelerated programs to kind of just learn a little more about legacy creation. I've talked to a few family offices that have set up their own education internally. Like they've done like an actual offsite for the family, and they've actually kind of organized it in a professional way. So I thought that was really interesting. And I think one thing that's also top of mind that some people have been talking about is separately managed accounts. So, that's kind of been a great vehicle for some families to kind of get access to some type of assets. And then I think it's also been helpful for managers to kind of use those separately managed accounts to kind of be able to be accessible to larger entities, and, partner with an RIA to to do that. So I was wondering if you had any thoughts on just kind of just the utility of using separately managed accounts to provide access on both sides.
Yeah, so I think we kind of we kind of explore that with our, as I mentioned, the vehicle we use to invest.
Mm-hmm. Yeah.
Kind of consider a more complex SMA for our families,
Mm-hmm.
and that like I said, has the 5 sleeves of the asset classes, which a defined pool of capital every year. So everyone commits at the beginning of the year,
Sure.
and then we then allocate amongst that. That helps us also just with a deployment perspective, right? So as funds are coming back into the market at varying time frames, as we've seen over the last few years, having that visibility into what we're able to commit that year is really helpful. It helps the GPs plan, and it helps us plan. From an SMA perspective, there's also the ability for a family that comes in with, maybe they just have a mandate that we really want to fill X asset class, like credit, for example. Can you help us build a credit portfolio? So in that scenario, we'll work with the family to define what it is they're looking for, the size and the structure, and then create a plan for them, an SMA around that. So the good part of being kind of our size with the number of families we work for is the flexibility that we have and the ability to get creative to solve problems for the families.
Sure, that's helpful. And then for managers, just to give some mentorship to the managers and give some advice to the managers, what are some of the things that you think about as you're going through the diligence process? Do you have like maybe just maybe a 5 or 10 piece checklist of just kind of things that are super important? Obviously in the data room, there's critical aspects that they have to kind of include, right? So as you guys are thinking about asset allocation, what are kind of the hot topics? Number one, for just the data room and the quantitative pieces that are table stakes, and then when you think about just kind of the integrity of the manager and just the personality, what are some of the soft skills that you're looking for as you're taking a chance to kind of make a new allocation?
Yeah. So, as I mentioned before, I think, our number one quality will always be character, right?
Mm-hmm. Yeah.
How are your interactions with your portfolio companies, other GPs, your history? Are you collaborative? Are your deals above board? I mean, we've had some managers come through that have pretty impressive performance, but you kind of start digging into the relationships around it, and more questions come up.
Sure.
And so that's, we spend a lot, like as I mentioned, a lot of time getting to know people. Performance is obviously important.
Mm-hmm.
With, kind of our focus on lower middle market and also emerging managers, we're looking for fund managers who, have kind of a proven track record that we think is replicable, on their own going forward. So, they may have rolled out from a larger institution to kind of start their own strategy. Their track record has come through. Do we think they can repeat that going forward? And then, kind of looking at their portfolio companies and, obviously investments that they've made existing. That's a little trickier with first time funds, obviously.
Mm-hmm.
But kind of learning and then meeting the team. So understanding how they invest, what their thesis process looks like. How do they do due diligence? How involved do they get? Because you see a varying level of involvement from firms, right? You have people that write checks, and then you have people that are kind of deep down in with their portfolio companies, side by side, solving problems,
Sure.
getting things going. I think we also look for kind of depth and longevity. Do we think this is a strategy that will last over time? And then, kind of also too, I think something we look for is, consistency in size. So that's also a risk you take with emerging managers is, the first fund may be 200, but then they come back for, fund 2 and it's 500, and then,
Mm-hmm.
up and up. And is that going to make sense along the way? What is their long-term plan? How do they see the growth of their investment firm come through? So, we also spend a lot of time kind of on operational due diligence. What is the structure of their firm? How are they running it? Kind of all the checks and balances around, administrator and, cash controls, and kind of the non-sexy part of the investing is kind of getting behind the scenes and making sure that the trains are running on time and they're running the way that they tell us that they are. Because I think, as we all know, there are a lot of different things that can happen. So we spend a lot of time digging in on that side. But, I think those are kind of our highest, higher level focuses. It's been a long time talking about our due diligence process, but it's a hand-in-hand process. We spend a lot of time meeting with the managers over time. As I mentioned, it's pretty rare for us to meet someone that's actively fundraising and invest in a fund. Usually it's, we'll meet them, get to know them if it's compelling, and we kind of keep watching. So, but as I mentioned before, our goal is to create longer term partnerships. So while it may not be an investment today, it could be an investment in the next fund, which will then, in our hope, span the next however many funds.
Sure. Yeah, that's really helpful. And then when you think about, institutionalizing your operations, what are some of the pivotal moments that you're seeing where you need to actually make serious changes? So obviously, like, when you're a $50 million fund going to $150 million fund, and then obviously from maybe the next stages, there's massive changes when you get to like 500 million. Can you maybe talk about a couple of those increments and like maybe some of the operational infrastructure changes that are needed? So we had somebody that came on our podcast the other day that does IT consulting, and they actually have a due diligence checklist for like your IT infrastructure. So I know there's a bunch of documents that you have to put together in terms of like, have you set up your antivirus infrastructure, right? But if you're like a $30 million manager, they probably are buying like the $100 Norton antivirus package, right? So can you talk through like, just, I think this would be really helpful, just kind of maybe the increments of the graduations, if you think about it, like, hey, if you're 200 million, you need to have these things set up, and you need to have cyber, this, $10 million of cyber insurance. And then once you get to $1 billion, it's completely different, right? The infrastructure is, you're not using Google Docs anymore. You got to use Microsoft.
Yeah.
So maybe you can talk about that. I think that'll be really helpful, especially for the LPs too.
Yeah. So, I think as we meet with cutting out. You what? Mm-hmm. Sorry, my Wi-Fi just cut out.
No worries.
Do you mind repeating that?
It's about. No, you're good. I think if you want to just repeat that, we'll fix this at the end. But yeah, it's a bad day for Wi-Fi for both of us, but we'll get through it.
Yeah. So I think in our diligence process, we've kind of seen a broad range, right? Like, and it's always fun with our newer analysts who start getting involved in the operational due diligence process to kind of see the range, right? As you mentioned, you have some emerging managers that are just getting started, and they're kind of all over the place, and they're really good, at investing, but the structure's kind of coming along with it. And then you have some where we're going into, an operational due diligence meeting with a 200-page DDQ and policies and procedures, and everything is, typed out, just really well defined. I think, there's a balance between the two. I think overall, what we look for with a GP from an operational due diligence perspective is, do they know what they're doing? Like, obviously, as you mentioned, there's a range. You can spend, millions of dollars on consultants and programs and software and different things. But ultimately, there's kind of a base level of what you're trying to achieve, right? Like, do you have controls around your, cash control processes, right? Like, do you have controls around your information security? How do you communicate with your LPs? Are wiring instructions secure? Who is monitoring that? And so I think really, kind of what's at the base level is just determining, what your policies are and how to best achieve them. Cybersecurity is hugely important these days. And I think that's something where you definitely is, worth spending the capital to have an excellent cybersecurity team, just with the, the creativity of some of these, fraudsters that come through, and just, the funds that they're looking for, and changing, wireless instructions. And you have so many moving parts with, wires coming in and wires going out, LPs and things like that. So I think cybersecurity is super important. As I mentioned, controls over cash and accounting. And then using good third-party providers, I think, is really important for GPs. If you're smaller, I think it's worth, engaging a well-known administrator, tax provider, things like that. I think that brings a level of comfort in the diligence process, understanding that, okay, you might be a small team internally that may not have the depth of, some fund that has a 30-person operational team, but the people that you're using are of a top tier caliber and can help you fill in the gaps that you cannot do internally.
Yeah, there's a startup that's innovating on some of the email dupes that people are doing now. I mean, I witnessed this, a couple times. I mean, I got a few emails from Carta, and it said like distribution. Click on this link to open up the documents, and look at the distribution for fund two. And then if you look at the email handle, it's like a weird,
Right.
email address. So it's getting. And then I got something from my university. It was the same thing. It looked like super legit, with all the same signatures and everything. So it's getting much more, crazy and sophisticated. So I think definitely having, some type of AI that checks that or something like that, or
Yeah.
at least just detects the email domain,
Right.
because I think it's getting more and more of a problem now.
Yeah, it's definitely something we've seen pop up. And like you mentioned, I mean, we get emails from clients, we get things internally. We have a cybersecurity consultant that we use, and we run, quarterly phishing tests and things like that to kind of keep employees on their toes. And, everyone is responsible, and they just go after people.
Yeah.
So that's something, that's super important for us. Think of, from an operational perspective, what else, is really kind of key. I think, documentation is great. I think, when we meet with a newer fund and they have a DDQ, they have a lot of that information prepared, valuation policies, are written out, having a lot of things that, just data that they can share. Because a lot of people can talk to things, but I think having things put together, that you can kind of distribute to, potential LPs is really important as well.
Yeah, that's helpful. Well, I know we got about 4 minutes left. I think a couple more things that could be interesting is just what's top of mind. So as far as the LPs, what are some of the most important things that they are, maybe discussing with you? And then the second piece to that is, what are some of the trends in terms of investment interest? With the current market, are people leaning into a little more venture, or are they looking at more middle market private equity? Because that's where really the revenue and the value creation is, and some of the EBITDA is there as well, even in this stage. So are you kind of seeing different appetites across the board, just holistically, and then just maybe some things that are top of mind?
Yeah, I think, so I think from the family perspective, I hate to keep saying this, the families are all different. So some of them are kind of planning for, events that are happening now. Some are more focused on their longer term, what that's going to look like. As I mentioned, for them, we work with them individually to kind of create the allocation, the cash flow that makes sense for their portfolio. From an investment perspective, I also go back to kind of that's where our endowment focus comes back in our kind of structure, where we invest in the 5 asset classes annually, is to, while there are things we do find exciting and seeing, opportunities in credit or space or, some of these different things, real estate, we like to stay disciplined and, we don't want to be cute with timing on, what's really exciting right now may not be, over the longer term. You can kind of look back, we still think venture, there are great venture managers out there, people we've invested with. But you kind of look back on, if you look 6 years back as to what people were really excited about in venture, that were, unbeatable companies that were, worth $1 zillion then. You kind of fast forward to now, and a lot of them, either are not or not existing anymore. So for us, I think, being disciplined with our investments, across our allocations, kind of sticking to, as I mentioned before, getting capital in the hands of good allocators, I think is what's most important to us. So I think, there are things that we get excited about and things we love to talk about in investment committee, and kind of new things that pop up. And, we'll look, if there's kind of a specific niche within one of those 5 asset classes, we'll start, exploring new opportunities. And that tends to be a great spot for our direct investment program. But really, it's kind of just staying, slow and steady and disciplined, and investing for the longer term. So, not investing for the end of this year, but investing for 10, 20, 30 years out for the families.
Sure. Well, hey, this was amazing, BA. Really appreciate you making the time, and thanks for all your patience, and hope to see you soon. And, this was a huge value add to the community. So thanks for all that you guys do for the families, for the managers, and for the larger asset manager community.
Thank you for having me.
Yeah, absolutely. It was a lot of fun. Take care. Thanks. Bye.